But let's talk about the supply. The supply is the shares themselves. And for the most part, the supply stays the same. But let's dig into a couple different scenarios where the supply can change. It's important to understand company management can fundamentally change the supply. And what we want to talk about first is how shares are put on the market. So shares are usually put on the market initially through an IPO, an initial public offering. And any stock that trades on a public exchange will have a certain number of shares issued. But keep in mind, behind the scenes, a company has a number of shares they're authorized to sell. So just because a company has 1 million shares issued, they may have 10 million shares authorized, meaning just because there's 1 million shares available for sale in the open market, it means the company could potentially add another 9 million shares on the open market. Let's say a company went ahead and did that. So before, there was only 1 million shares outstanding. Now there's 10 million shares outstanding. This is called share dilution. But on the opposite of that, a company can buy back shares. So this happens with profitable companies. They have lots of profits, and a strategy for the company would be to take some of the profits and use those to purchase shares on the open market. And what that does is it makes a smaller amount of shares available to the public. The amount of shares available to the public is called the shares float. And as the float gets smaller, what it does is it kind of drives the share prices up. There's less supply, the prices go up. So the share dilution makes sense. There's more shares pushed on the public. The share buybacks make sense. More shares are taken away from the public. Where it can be a little bit confusing is the stock splits. And perhaps you've read in the news about a 2-for-1 stock split. So a 2-for-1 split is when an investor receives 2 shares for every share of stock owned. So if you owned 1,000 shares, a 2-for-1 stock split means you now own 2,000 shares. And the opposite would be a 1-for-2 split. For every 2 shares you own, you're only going to get 1 share, or you're only going to get 1 share for every 2 shares you own. That's called a reverse split. And let's just talk a little bit about the supply and demand with the splits. So the concept here is with a 2-for-1 split, let's say the shares are trading at $10 and you own 1,000 shares. When the split occurs, the share price usually goes in half. So it would go from $10 to $5. But as an investor, you have twice as many shares as you had before. So instead of 1,000 shares at $10, you have 2,000 shares at $5. So the dollar amount is still the same. The 1-for-2 split, the idea there is the share prices double. So you had 1,000 shares at $10. The idea is they're split in half, so you only have 500 shares, but perhaps the prices rise to $20. There's no guarantee, again, of what the prices will do. It's all about buying pressure and selling pressure, but what we're talking about here is fundamentally changing the supply, and this is the management, of course, changing the supply. So now you know exactly what can happen in the market in terms of supply.